Brent crude just fell below $80 a barrel. And the reason is a development that almost nobody predicted 6 months ago. The United States and Iran are 60 days away from a formal peace agreement. If that deal holds, it doesn't just change oil prices. It changes inflation. It changes the Federal Reserve's playbook. It changes mortgage rates, gas prices, grocery bills, and potentially the outcome of the next election. In the next 10 minutes, I'm going to break down what a 60-day peace roadmap in the Middle East means for your energy costs, the American economy, and every other market that oil touches. Because few things move the global economy as fast as oil, and right now, it is moving. Let's start with what happened. Reports emerged this weekend that U.S. and Iranian diplomats agreed to a 60-day framework, a roadmap toward a final peace agreement. No deal has been signed. No sanctions have been lifted, but the 60-day clock has started. The immediate market reaction was sharp. Brent crude, the global benchmark, fell below $80 a barrel, its lowest level since early spring. West Texas Intermediate, the American benchmark, dropped in tandem. To understand why this matters, you need to understand how much oil Iran sits on. Iran is home to the fourth largest proven oil reserves on the planet, roughly 157 billion barrels. Under current U.S. sanctions, Iran can only export roughly 1.4 million barrels per day, largely through workarounds and gray market sales to China. If sanctions are lifted, and Iran's oil flows freely into global markets, analysts estimate Iranian exports could double to 3 million barrels per day or more within 6 to 12 months. Adding 2 million barrels per day to global oil supply, in a market where OPEC has been carefully managing production to keep prices elevated, is a significant shock. Goldman Sachs analysts have revised their end-of-year Brent forecast to the low 70s if a deal materializes. That's real money. Every $1 drop in oil prices translates to roughly 2.5 cents per gallon at the pump. A $10 drop in oil, from $80 to $70, means roughly 25 cents less per gallon of gasoline. For the average American household that spends around $2,000 a year on gasoline, a 25-cent reduction saves about $200 annually. That's not transformative, but it's real. The bigger impact is what lower oil does to inflation. Energy is embedded in the cost of everything. When oil prices fall, trucking costs fall, airline tickets fall, manufacturing costs fall, agricultural costs fall because farm equipment runs on diesel and fertilizer is made from natural gas. If oil sustainably drops $10 to $15 per barrel over the next 60 days, the consumer price index could drop meaningfully. The PCE inflation measure, the Fed's preferred gauge, could shift from 3.6% toward 3% faster than current projections suggest. And here's where it gets critically important for interest rates. New Fed Chair Kevin Warsh has said explicitly that the Fed's decision on rate hikes depends heavily on inflation data. If inflation was running above 3% partly because of elevated energy costs, which it was, and oil drops, inflation comes down. Lower inflation removes the pressure for rate hikes. Markets could rapidly reprice from expecting a 75 basis point hike to expecting no hike at all. That shift would be enormous for financial markets. Mortgage rates, currently above 7%, could fall towards 6.5% or lower. Bond prices would rise. Tech stocks and growth assets would get a boost from lower discount rates. And the housing market, frozen by affordability constraints, could see some relief. But, and this is critical, none of this happens until a deal is signed. The history of U.S.-Iran negotiations is littered with broken frameworks, collapsed talks, and unexpected crises. The 60-day roadmap is a beginning, not an end. Multiple things could derail it. A military incident in the Strait of Hormuz, a hardliner veto in Tehran, a political reversal in Washington, or a breakdown over nuclear inspection terms. OPEC is also watching very carefully. Saudi Arabia has a direct financial interest in oil prices staying above $80. If Iran's oil returns to the market, Saudi Arabia and other OPEC members may cut their own production to compensate, partially offsetting the supply increase. Goldman Sachs laid out the scenario clearly. A successful deal takes Brent to the low 70s. A deal collapse takes it back above 90. The spread between those outcomes is $20 per barrel, an enormous range of uncertainty. For consumers, the message is cautiously optimistic. Gas prices may fall in the coming weeks as markets price in the possibility of a deal, but don't assume it's permanent until ink is on paper. For investors, watch energy stocks closely. Companies like ExxonMobil, Chevron, and ConocoPhillips will face earnings pressure if oil drops significantly. Energy sector funds could underperform if the deal progresses. For the broader economy, this is potentially the best news in months. Cheaper oil is a tax cut for every American who drives, flies, buys food, or heats their home. 60 days, that's the window. Subscribe for daily updates on the economic and geopolitical developments moving markets. We post every single day, so you're always ahead of the next move. I'll see you in the next one.